the more you understand, the better you have over it, the less stress it will give you in life. I mean, I think that's the most important thing that we want to take away from this, is knowing that at the end of the day, when you have a good sense of your finances, what's happening with them, what's going on with the market, any challenges that you may face, job loss, that kind of thing, it's important to know, there are ways to manage through those very impactful situations in your life. So with that said, I want to pause and ask if there's any, burning questions that you would have for someone who's been teaching financial literacy a long time. Anything that you would think, can we focus on this as we go through this session so that we cover pertinent issues that you're faced with today? So I'm just going to pause there and let some questions come in. I know Michelle's managing the chat for me, but if there's no questions, I'm happy to kind of dig in.
Yeah, I have a question.
Sure.
So I'm I'm 22, and my friends who are 23 and in the labor market working have all texted me in the last 2 weeks telling me that they're setting up their Roth IRAs, and I am incredibly intimidated by that and don't really know the difference between an IRA or a Roth IRA, or like what is the smart move to do in order to start preparing for this, or like the entire topic of like long-term savings. I find very intimidating. And if you could offer some insight on that, I find that really valuable.
Okay.
Thank
Yeah.
you.
Just writing down your questions so that we can let other folks chime in with questions, and I'll make sure we can, we'll cover that for sure.
Thank you so much.
Any other brave souls want to make sure we cover that? Because that's a big question. Okay, we can move on to the next slide then. Or am I missing?
Can I ask a question?
Of course, please do. Jump in.
Yes. One question that I've been thinking about is like how to budget. Like, what are some like apps that you might recommend if you don't have Bank of America? Because I think that you guys also offer an app or something to help. Like, I have actually TD Bank, and a lot of Clark students do. Like, what is like a good way to like budget and go that way with it?
Sure. Yeah, we can definitely cover that. Okay. So it sounds to me like you all are pretty advanced, which is great. I'm going to cover banking basics for those who may not have felt compelled to ask the question, but I'll do it quickly because, again, this is being recorded and we'll give you these slides. And I'm also going to give you our online resource because I think that's important for you to be able to access things and potentially, you may have more questions, and I'm happy to share my contact information afterwards to make sure that you feel you've addressed anything you were not comfortable with sharing here. So if we can move on to the next slide on just our banking basics, it'll show you, how banks work. That slide is slide number, 4. Here we go. So the basic idea of banks is really, you put your money in banks and it's your money 100%. But banks are giving you, or they're supposed to be giving you, some sort of interest because their bread and butter is to give out loans. And so for all the deposits that they receive, that gives them the ability to basically allow borrowers, if they're going to buy a car, or they're going to buy a home, they're doing all of these kind of life events that are happening. Their ability to do that is based on the deposits that they have. So you'll hear a lot of that when thinking about banks overall. And so that interest difference is what the bank makes. So you make, say, 1%, and they're loaning you for your car 3%. Well, that difference is what the bank, quote unquote, earns. And that's their ability to basically continue the cycle, right? It's the profit that they make. So it's important for you when you're thinking about your banks is choosing a good bank. So I know a student just mentioned they bank a lot with TD Bank, which is great. I mean, this is not a Bank of America themed thing. I think when you're shopping banks, you must always shop banks. And I work at Bank of America. It's 100% okay to do that. It's important to know rates matter, what you're making on your money matters, to be very much involved in that piece, because interest rates are how you make money on your money. It's a very small piece of it. It's how your basic savings is going to happen, is going to be from the interest rate, if that makes sense. So the next slide, on slide 5, it's going to basically allow you to differentiate between what is it that I want, right? Do I want a money market account? Do I want a savings account? And how much do I need? So you need to ask your banks when you're shopping them, what's my minimum level? How much can I be there? What are the fees if I overdraft? Do I have to have direct deposit to avoid any fees? If do I get checks with a checking account? And if I need to order more, is that expensive? Do you have a good online banking platform? Is it very secure? Do you have a good fraud prevention? Right. So don't feel scared to ask these kind of questions, because they're making money on your money. Rest assured on that. So you want to make sure wherever you place your dollars, that it's in an institution that you feel comfortable with, because they were very much willing to answer these kind of questions for you, and that you understand the kind of accounts that's going to work for you specifically. So if you get your first job and you set up, in most people are going to want you to set up a direct deposit. Most of the time you will not have fees associated with your checking account. So keep that in mind, right? You're setting up a direct deposit, which means you don't have to cash anything. You don't have to go to the banking center. And now everything is very much digital. So you might not need the first issuance of checks, right? It's not as important, because you send your money via Zelle, or you send your money via PayPal, or you use one of the many what we call fintech apps that allow you to basically send your money on your phone. And you don't even have to worry about ever entering a bank. So I will pause there. Are there any questions on, the different types that you may want to look into, or any specific questions on things that you may have seen? Let's jump to slide 9, Michelle. So, the student that just asked the question about a budget. It is extremely important to create a budget. And yeah, these apps make it very easy. And I would say, from my perspective, it doesn't matter which app you use, and it doesn't matter, there's not one more friendly than the other. They're all competing on the fact that they're very much digital. They're supposed to be very friendly. I myself have, multiple apps that I've used. And I just stick with, the app that I'm used to, because I like that I don't have to continue to input my information. You can connect your accounts. You could connect, if you have a savings account in TD, but you have your checking account with Bank of America, no big deal. Some of the apps will basically keep that information for you. What the most important thing is, though, that you're creating a budget. So the fact that you're looking into which app will make it easier for you, great. But really, at the end of the day, the basics is to create your monthly budget so that you have a good grasp on what your cash flow looks like. Why is that important? Because to have financial independence, right, you're going to want to understand, what are my fixed expenses? What am I not able to move if my income for some reason changed? Or said another way, what are my variable expenses? Like, do I need to go on vacation right now to, Thailand? Or do I need to save up for my deposit on my rental with my roommate, right? Like, so the budget will allow you to create something that you're going to be able to say, okay, I'm going to do both. I want to get into my apartment by November, and I want to go to Thailand for New Year's, right? So you're going to be able to manage that by knowing how your money moves, what's fixed and what's not, what's variable, what can you save. And that's very important to understand, because that's going to allow you that ability to do both. So the next slide is really just talking to your income. And right, it's like anything else. Most people, their income is tied to their wages. Now, allowance is like, if you get allowance, great. If you have gifts, anything is income based. Usually, what you're making when you come out of school. You know what your salary is. So that's the beginning of your budget. That's the top of your budget. What am I making? And then you can basically know, what can I spend? And so the way I would caution you is to know, you want to make sure that you always live within and below your means, because what you want to always budget is saving or paying what I call yourself, right? Everybody's always going to have bills. You're going to retire with bills. What you're not going to have is the savings to allow you for that long-term savings plan if you're not thinking about paying yourself. So you have to think about yourself as like you would a phone bill. You want cable, you want Netflix, whatever the case is. If it's all you can afford is $15 a month, it makes a huge difference. So I will, really emphasize that because I think that's really important. I myself graduated with over 6 figures in student debt. I had 3 jobs out of school. And the challenge for me was still to find money that I could save, right? That was very important to me. And at first, it was $50 a month. It was literally, all I could do. And then as I got promoted, as I got different income from different job sources and things like that, I was able to set aside more. But it starts very humbly because it's about creating the habit. It's about knowing that your ability to have that discipline of saving for whatever it is, even if it's your apartment or your car, it's very much about creating that habit without necessarily overdoing it on the expense side. You're not charging your credit card for everything. You're not, once you get into credit cards and debt accumulation, it's very difficult to save because you're constantly trying to catch up. So you want to have a very balanced approach and make sure, again, you are living below your means so that allows you the ability to save and pay yourself. Our next slide is about paychecks. I think it's really important that when you're thinking about offers and coming out of school, you think about what they give you, that number, it sounds really great, or it sounds bigger than what it will be. And that's really because of your insurance plan. You pay for that. Your federal and state income taxes, right? So it's really comes down to your net pay. And so a lot of times you'll hear these recommendations to save 30% of your gross income. And that sounds like, oh, it's not that much. 30% is not that much. But when you look down to, if you compare your 30% of your gross income to your net pay, it will feel like a lot. So be understanding that when you're negotiating your salary and you're understanding that you're going to get a certain paycheck, it will look very different than the actual sum number that we're talking to. So it's why budgeting is a little bit easier when you go month to month and you look at your net income. In my mind, it's like set yourself up knowing what you're bringing in every month after you've paid your taxes, your insurance, things like that. And then you allow yourself the ability to say, okay, what am I comfortable spending and what do I want to save? Always think that way. Think in the way that I want to make sure I have that ability or that, flexibility to make sure you're able to do both. So the next slide and slide 12 will tell you to track your expenses. And those are what those apps are for. It's to make it easy for you. The biggest thing I say that apps are for is to basically, it feeds to you and kind of, they make charts now. It's very fancy. It'll show you all these things. When I started making a budget, it was in Excel and it had nothing to do with charts. It was like, how much money do I have at the end of the month? And so what tracking does for you is allows you to say, my entertainment expense just went up from $80 in January to $100 a month. I couldn't really afford that difference, yet I did it anyway. Let me readjust. I think it's important to see those trends in how you're spending your money because it's unrealistic to think that every month is going to be the same. That's not really what's going to happen, right? You go out on that vacation, you spend $1,000, and now you've thrown off the rest of your budget for the remainder of the year, but you planned for that. And so it's important to think about that. It's not going to always look as clean as this. So that's why, don't focus so much on the apps itself, but really look at the trends that they're showing you and say, okay, was I disciplined enough to stick to my plan? And that'll make a really big difference. And so the next slide, it's common sense for you guys. If you're spending on small things, but you're saving for a bigger thing, those challenges then become small things add up, right? So be careful with the choices that you make if you have a broader goal. And so you want to make sure you're balanced in your approach. You want to not be able to spend anything. You want to be able to go out to the movies. You want to have entertainment. You want to do these things. But at the same time, you want to make sure that there's more left of your paycheck to do other things besides the small stuff, which adds up very quickly, especially if you're using your credit card and you're paying interest on those expenses that you could have paid in cash and would not have cost you. The other, I've covered most of these slides, so I'm going to skip ahead a little bit. So here on slide 17, it basically goes through the difference between savings accounts and CDs. I would say is when you think about, your goals and creating your goals, if you're thinking about a bigger goal, like say you've accumulated $1,000 minimum to open a CD, and you realize that interest rates are very low, you have to be able to understand that if interest rates are very low, then I'm not making much money in my savings account. How do I maximize the returns on my money just sitting in an account? Because trust me, the bank is always thinking about maximizing their returns. So you have to think about, okay, this is my money, I need to do the same. And a CD is one of those options. It's not the only option, but it's one of those options that allows you a little bit of higher interest rate. Now I say a little bit higher because, the banks can only offer what the Federal Reserve is doing, right? So right now in the economy, we're struggling a little bit, right? So the Federal Reserve has interest rates basically at zero. And what that means is you're not making much money in your checking or your savings account. And so CDs are just only slightly more. And it's the product of having very low interest rates. But then call your credit cards. Make sure you're checking in and saying, hey, interest rates are very low and I feel my interest rate is high. Can you lower it? And always do the check-in call, because they're not going to do that for you. That's you being your own advocate and understanding money enough to know that will make a difference. Let's go to slide 19, which is managing credit. Managing your credit is very important. This comes down to the discipline. What I find, even amongst my friends, you need a car. Everybody that has to drive to work needs a car. But what they want is the fancy car. And you can get the loan and you can get 5 years and you can pay X amount of interest. And the challenge then becomes, did you need it to be that high of an expense? And did you think it through when you were really, really shopping these cars and the cost to you before taking on that expense? Because now you've just added to a fixed expense. So you really need to manage your credit. Many, many creditors, and I'm saying this as a lender, are more than happy to give you a loan. But the challenge is you have to understand, because they're making money on you. So for example, I have credit cards, I pay them every month. I have not always been in the position to be able to do that. And it's important to understand that, say I bought something from Best Buy and it was $100 and my interest rate is 20%, the next month it cost me $120. And would you have bought that same item had it cost you 20% more? And you really have to think about that, because managing your credit impacts everything later in life. And you don't want to get yourself in a position now where you are basically underwater, which means you're spending more than you make. And it puts you in the position to set you up where you wouldn't be able to buy the house because your credit score is struggling, because you weren't able to pay that credit card back in time. So that discipline and understanding your credit is very important. Now, on slide 20, this just talks about credit reports and the importance of knowing your credit, right? So when you're fresh out of school, you don't really have credit. So don't worry so much about the actual score of it. What you're doing is building credit. And the reason you want to build credit is because, again, it's going to impact you in all factors of life. Now they're doing, even for when you're applying for jobs, they're doing background checks that include a credit background. And why do they do that? They want to know you're disciplined and responsible. And so the challenge then becomes, well, I spent this and I didn't get to pay it back all of a sudden, but how does that impact my job? Well, they're wondering, okay, well, if you're not disciplined here, does it also translate here? And so just be careful with that, because there's repercussions to things that we seemingly don't think are a big deal, or we missed a payment, or even your student loans. If you're paying back debt and you miss, it's better to call your creditor and work with them than them reporting it to the credit agencies and then you basically getting a derogatory score, which impacts your credit in a bad way. And you never want that to be the case if you can help it. And you can check your credit score online. There's a bunch of free apps, creditscore.com, that kind of stuff. They all market now, but it's important for you to check it so that you know also if anybody's using your social, your name. There's a lot of data mining. There's a lot of fraud out there. And it puts you in a bad position if you're not even aware that people are using your name to open up credit cards and things like that. So you want to be able to fight that as soon as you see it. I recommend checking your credit score at least twice a year. The next slide, credit scores, it just shows you basically what makes up your credit score. And I think this is important because payment history is 35% of that. It's the biggest one. And so this is what I mean, like, do not miss a payment. That's very important. Always work with your creditors if you can, if for whatever reason you've gotten yourself into a situation. Then 30% is amounts owed. So let's, for example, say you have 2 credit cards, one with $1,000 limit and the other one has 500 on it, and you've maxed them out. It's not that it's a huge amount. It's only $1,500. It's the fact that you needed to max them out. So in the mind of your creditor, it's almost like we are more willing to lend to you when we know that you don't need it. It's why people feel, right, like banks aren't lending. They're not giving us money. We need, the challenge is you have to have a really good payment history, and you have to know that you cannot max out all of these things, because needing your credit is basically saying to your lender, I am spending more than I make. You always want to have that as a luxury. Now you get points, you have travel rewards, you use your credit card as a luxury versus, a personal line of credit, which it technically is, but that you cannot pay back the next month. And then the rest are basically length of credit history, which will just come in time. So don't even worry about that. Types of credit in use. Your student loans are not, they're not bad debt, right? Everybody always talks about this quote unquote bad debt versus good debt. But if you have derogatory score on your student loans because you weren't able to pay a month, it's still going to ding you. So that's why I don't go by that, bad debt, good debt. Just know that it will impact your score. And then that will later impact your ability to get good interest rates on credit cards. That's a big thing. If you have a bad credit score and you get a credit card and they still give you a credit card, they will charge you for that. You're a higher risk to them. They've assessed that. And so that will be, instead of, say, I get a credit card and it's 8% interest, and you have a bad credit score and you get a credit card for 22% interest. So now if you do leave a balance, you're going to owe more because you have a bad credit score.
Stephanie, we have a related question.
Sure, yes. Thank you, Michelle.
Sure. How badly does closing a bank account affect your credit?
Closing a bank account does not affect your credit. Do you mean a credit account? Like, do you mean a credit card?
I think the question is how badly does closing a bank account affect your credit score?
Okay. Closing a bank account will, like, switch banks as often as you want. That does not affect your credit. Remember what a bank account is in the basic definition of a bank account. That's your money you're depositing. That is not what you're borrowing. Credit is, in the raw sense of the term, is what you borrow. So when you use a credit card, you're borrowing. When you open a checking or savings account, you're giving the money to the banks. So closing that out, saying, I want all my money, that's your prerogative to do, and that has nothing to do with your credit score.
Great. I have a couple other questions, if now's a good time.
Absolutely.
One student asks, what stage of life do you recommend someone apply for a credit card? I want to build my credit, but I don't want to be tempted by suddenly having the credit card to use.
I think it's important to build now, and you're in college. And I think what you need, when we talk about temptation, it's like anything else, it's about discipline, right? So of course it's easy to be tempted to do anything, right? Like if you want something new and you feel like you can't afford it, quote unquote, but use your credit card, just be careful, right? Like, but build a credit now if you can. On the next slide, Michelle, if you just want to just jump to that real quick. Opening up a secured credit card is one way to basically stop the temptation, right? You put cash. I mean, it's kind of like a cash secured credit card. So say I want a credit card with $500. The bank will hold $500 for you and say, okay, but that's kind of like a checking account. So that's what I'm saying, like, have the discipline, because you don't need to do it that way. But many people will if they feel like they cannot be disciplined enough to not overextend themselves with credit. So you can do a cash-based account. You could also be on a family member's account. The challenge with that is always going to be, be careful, because you don't want to overextend your family's account either, right? So it's about being disciplined and having that start. And, you start by charging your coffee, and then And by the end of the month, you have, let's say you put $300 a month on your credit card, that's 300 a month less for your savings. So make sure we're balanced in our approach of spending versus savings. To have someone co-sign a loan for you is a big one, because you're building credit once you start paying back your student loans. So, if you have student loans, let me put it that way, because it was very important. My mom, like I said, co-signed for over 6 figures of student loans. And if I hadn't missed one payment, it would have impacted her credit. And so discipline, right? You got to be really, really good about, if you're going to use the good name of someone else's credit, you're going to want to make sure that it's because they can trust you and you feel like you can handle it and you haven't overextended yourself. And Michelle, sorry, I'll pause there. I probably over answered that question.
Oh, that's terrific. One question, can you start with a secured credit card and switch it to a regular credit card account later?
You won't switch it. It'll be, you would close that account. The secured credit card is like, it has one purpose. Like even now, let's say I have a credit card that I used to live in the West Coast, Los Angeles, and a lot of my flights were United, so I had a United credit card. There's an annual fee, but in Boston, United is not a hub. So I can close that credit card and open a new credit card. This whole idea of not closing a credit card is a double-edged sword. And I say that with caution because, if for whatever reason, let's say you woke up and you were like, I'm opening 7 credit cards. It's too many credit cards, right? But you open 7. And then you walk into the bank and they say, don't close your credit cards because it's really bad for your credit. You have too many credit cards, right? Close some of those. You shouldn't have any store credit. I mean, I'm speaking from a very conservative position because you want to maximize your returns. You do not want to pay high interest. And the Macy's cards and the Best Buy cards, the reason they offer to you at the checking, like, know that there's no good offers that come to you when you're checking out for an item, right? Those offers are the highest interest rate possible. They know that you're shopping. They're saying you get the 20% off the first purchase, and then you're like 22% interest. And it's like crazy, right? So if you were to take advantage of that offer and you're like, no, I'm making a big purchase, it's 20% off, it makes a difference, cool. But then close that credit card because, you don't want to constantly do that. You want to have a solid credit card. Like say you have 1 or 2 solid credit cards, but just be careful with the rest of the credit cards. That would be my advice.
Great. And one more question related to this topic. For upcoming graduates with little to no credit, what are the best credit cards to get to start building up credit?
Yeah. So, someone mentioned that a lot of Clarkies use TD Bank. TD Bank has plenty of credit cards. I mean, there's not one credit card versus the other. You have to look at how is it that you're going to use your credit card. So you're trying to establish credit. They're probably not going to give you a huge credit limit, but it doesn't matter. You're trying to do something, right? There's a goal at the end of the day. What I use is bankrate.com, and I'm happy to share that, Michelle, with you. It's literally just bankrate.com, and it will go through every interest rates. Like it'll say you want to look up interest rates for credit cards. You want to shop the lowest possible, but say for some reason now later in life, you're like, well, I like to travel and there's a mileage card, but the interest rates is higher. Well, it's because they're giving you rewards. So how you're going to use your credit card matters. In the beginning, make sure it's the lowest interest rate possible. You're trying to establish credit. The reward stuff doesn't matter yet. You're not there yet. Let's get to a place where you feel really good about where you are. Now you're traveling a ton. You have all these miles you want, or you want cash back, right? There's cash back credit cards, or there's reward programs that, like, for instance, you can subscribe to magazine. Like they'll do all these like little things, and it depends if you like that kind of credit card. But there are website searches that you can do. What's the best Visa? What's the best Discover card? What's the best American Express? And they'll go through and show you the differences between them, but there's costs. So like American Express will have 5 different credit cards, and you'll be like, well, why is that one $290 a year in an annual fee versus free? And so you'll want to research, because those higher premium credit cards are a lot of perks. And if you're not in the position to use those perks, you don't want to be charged an annual fee.
Great. And one last question before we go on. What's the biggest difference between credit unions and private banks?
I mean, we're regulated differently. It is a different institution. I think, for your purposes, if we're talking about basic banking, they can do most of those things. And now I think with our digital transformation, a lot of times what was hesitant about people going to credit unions was because ATM, was a pain. You were paying fees on the bank you were pulling from. There's not a lot of ATMs everywhere, right? So think about why people would choose TD Bank over a local credit union. Now, credit union also, I think the benefits of them is that they have lower interest rates if you're going for, say, your first home. And so you potentially could do that. But, there's pluses or minuses. As you're establishing your profile, shop them and see who's going to give me more interest for my savings account, who's going to charge me less interest for the debt for my car note, because I want a car or I want a house or I want a mortgage, right? So shop it and include credit, include all the agencies. I think that, now think about Rocket Mortgage as a fintech kind of thing, right? So that you don't have to walk into a banking center and get some of these products that were only if you walked in and applied, using paper. Right now you have all of these different resources, and I would say shop them. Do not feel pressured or obligated to stick with something if it feels expensive, or you feel like they're not giving you the full story, or you feel, like there's potentially a relationship that you've built with someone. There's a lot of reason to stick with them, right? So it's a personal preference.
Great, thank you.
Of course. So the next slide just goes over the do's and don'ts that I've covered. I mean, it's pay your bills on time, right? Pay your bills in full or more than the minimum. Now, I mean, there's always going to be these emergency situations where you're not able to pay your full credit card, right? Some people just use credit cards for emergencies and not able to do it, but try to pay more than the minimum, because it's crazy what they charge you in interest. I mean, it's like taking a loan, but really expensive loan. And you're not thinking about it like that because it's just month to month, but it's the way you should think about it. And then the other thing we talked about already, which is monitor your bills in your credit report. And then the don'ts is don't use all your credit, because maxing out your credit impacts your credit score. Applying for too many credit cards or lines of credit, and then, closing unused accounts. This is that don't right there. Just be careful with that, because that really just means, if you have too many accounts, close the unused account. It has never impacted me badly. I know plenty of people think about your student loans. When you pay that off, that's a closed account in a good way. It's a positive score on your credit score. So don't think if you have an unused credit card and you don't really need it, you don't, and you have a lot of availability on a credit, you don't need it. Don't be fearful of closing things off. So the next slide is the reason you really don't want to use credit cards. It's like a great thing and a bad thing all at the same time. And so that's why somebody said, use the word tempted, right? I don't want to be tempted to use credit. Credit is not a bad thing. I don't want you to fear credit. It's not a bad thing. Credit allows you this flexibility that you may not otherwise have had, but you have to have the discipline to know when to use it, and that you have the ability to pay it off quickly, right? And I think that's the biggest difference, because you can see here a $500 credit card, if you paid it off in 3.5 years, and this is very low interest, I'm looking at here, that's crazy. 13%, you're not really getting that right now, right? So it's very low interest, and you're at 624 for whatever it is that you bought at 500. So it's like you bought a TV at Best Buy for 500, but yet you spent $624. If you were in the store, would you say, oh, I want this $500 TV, and can I give you an extra $124 because, I'm feeling generous? It means you can't afford it right now. In my opinion, if you're saying, I'm willing to spend that much in interest, you can't afford it right now, and make your budget, create a savings plan, create a goal, so that in that time period, you're able to get there. And it'll make it a lot easier for you to be disciplined about having both the credit and having the savings goals accomplished in the time that you want them to be. And then the next slide. Well, let me stop there. Michelle. Is there any other questions on that kind of credit? And the next slide is managing student debt on 27, Michelle. many of you will have probably gone with student loans, and, you know, obviously it's for a great cause, right? You've got your education and it's investment in yourself. The debt that comes along with it can be very overwhelming. And, you know, I have a younger sister that just graduated Boston College with 6 figures of student debt. And I think, you know, the challenge then becomes, well, how do I become financially independent while still paying down this debt, which is 100% doable. I just want you to know that it's not easy. There's a lot that comes along with that. And it's a lot of discipline that you have to put in place to make sure that you're meeting your goals and you're still being, you know, really just diligent about the debt that you have. So I would say, you know, now that students are able to refinance student debt, make sure your interest rates are low. Make sure you've done the research so that you know, okay, I'm getting the best rate, or no, there's this refinancing option at the credit union, and they told me that I could save 3% on my debt, and that would save me over $20,000 in interest. That's something you need to consider. That's something that you really need to look into, so that you're, you know, nobody's going to do it for you. So let's be clear, like, everybody will take your payment on time and that'll be fine. You need to be your advocate. You need to know that you paying interest is making money for the organization that you are paying interest to. So if that's your credit card, if that's your, you know, any debt that you have, student debt, your mortgage, your car note, any organization that is taking your interest is making money. So make sure you are also very much aware of the money that you're spending and the money that you could be saving if you just chose, you know what, I'm going to close this account and refinancing out. I want to do something else because I would save a lot of money. Let me pause there because I think, Michelle, a question may have popped up.
Sorry about that.
No.
Yes, could you explain the term refinance?
Yeah, of course. So let's say you, well, I'll just give you my example. I had taken out a mortgage for a property I bought. We bought our first home together, and interest rates plummeted. So my mortgage rate was 4.25%. So 4.25%. And interest rates, people were getting mortgages at 30 years for 2.25%. So when I did some numbers, because I'm a banker, right, and I wanted to know the math, if I refinanced at that rate, I would save over $150,000 over the 30 years. $150,000. And that can't be like less emphasized in my mind, because what happens when you take out, let's say you buy a home, right? And you don't have cash to buy this home, and the price is $500,000. And so you take out a mortgage, you will 100% pay interest because they're giving you the money to buy the home. You didn't have it. And so when you refinance, you're saying, well, I want to pay you less interest. You can, yes, 100%, you're going to always pay interest. There's nobody that's going to give you the free money, unless you're gifted the money, and that's different, right? But you will 100% pay interest, but are you getting the best interest rate? So always shop around, and refinancing is literally the act of taking out a new loan that pays off the old loan with the same collateral. And, you know, I think the other thing to think about, even with college, right, is like your first job is really important to negotiate your salary. It's like, think of it as your stepping stone. I think it's very intimidating to get your first job offer and feel like really, really proud, right? And then, you know, come to find out someone else who started around the same time is making more money than you because they asked for it. The worst things that can happen when you ask for something, and I think it's all with tact, it's all right. There's negotiation classes that people take their entire lives, because this is something that you will deal with when you want a raise, when you want a promotion. It's about negotiation. If it's done with tact, there's no offense taken, right? Somebody is saying, hey, you know, thank you so much for this job offer. This is amazing. Is it possible that I can get $2,500 more? Whatever it is, right? That makes so much more of a difference to you than it does the organization that you're applying to. So think about it that way. You're not taking anything that you're not, you know, willing to work for. You're just basically trying to negotiate something that will help you along the way. So when you're managing your debts and you're thinking about renting and you're thinking about your insurance and your costs, you have a little bit more of that income piece to play with that will help you along, that doesn't feel like you are so constrained, if that makes sense. So I wanted to throw that in there. And then, you know, for your student debt, like I said, there's nothing more important than paying it on time and then shopping it. So let's say right now, I think most student debt was at 6.5%, and you can refinance at your local credit union or your local bank or a national bank for 3.25. You're going to save a lot of interest, and it's an easy calculation, and you can find a lot of those tools online that will help you. But make sure you do that. Make sure when you have that opportunity, you do that. The other thing I think is really important when you're graduating is, and this is slide 30, is just negotiating your lease. A lot of building is going on in Boston and obviously Worcester. There's a lot of new places, and you hear first month free, 13-month lease. And you got to kind of look at the details on why that is, right? I think that's important. So make sure you're negotiating your lease, make sure you're negotiating your terms. And it's important to understand when they say free, they've calculated the cost or the rent that you're paying, and they've said, we can afford to have this less. So in the next year, when they increase that cost, it's your opportunity to also renegotiate the lease to make sure you're not overpaying for where you're living. And you want to make sure you can afford it, right? So, you can look up, like, the average increase in leases in Boston is 3.25. Like, let's say it's 3.25%. You can say, okay, I can afford this year, but I have to move next year. Is that something you want to do? Or do you want to find a place that you can afford in the next 3 years so you don't have to move often, because moving costs money? And so if you're going to live with a roommate, make sure that both of you can afford it and both of you have good jobs. So you're not feeling like, well, now my roommate is out of a job and that's a challenge for them. And, there's implications to that as well. So, that's an important piece. I'll pause there, Michelle, just in case there's any questions on that.
Not on that point.
Okay. So then the next thing is slide 31, which is buying a car. I think in the city, Boston or New York, depending on where you choose to live, I didn't buy my first car until I was 28. And that was because I was moving to Los Angeles and I needed a car. I would say, remember, like, the cost of a car is way more than just the price, the sticker price or the lease cost. It's the gas, it's the insurance, it's the excise fees, it's the license fees. It's all of these things combined that make it where you have to backtrack those costs to know, can I afford this? And can I be comfortable? And can I still save for my goal of traveling or whatever that goal is, or paying my student loans faster, or buying a home earlier, or my retirement goals? So all of the things that you want matter when you're making these decisions. So, I think that slide 32 sums it up fine. Create a game plan for your student loans, right? Make sure you're on time. Make sure you're really always shopping interest rates. When you're preparing to move out, make sure you're negotiating leases. Make sure you're really looking at the terms and what it is that they're offering you. And then you can see if you can get them 1 month free. And if they say no, that's near, that's okay. And then transportation, whether you have a car or what's the cost of transportation, or, it matters where you choose to live, because how far you are away is going to matter for mileage, your gas expense, all that kind of stuff. And even commuter rail versus the train, right? Those are different costs that you want to keep in mind for your monthly budget when you're creating it. And you're in control of that, which is really empowering. The next slides are really about financial safety. These are important because I think it's just, there's a lot of fraud going on out there. This is slide 34, Michelle. And this is really just saying, be really secure about yourself. A lot of, students and young adults are using these, password things, that they're not locking their phone. You have to make sure that that sensitive information is to you, and make sure you're checking your credit report, because otherwise, it's very difficult to backtrack on that kind of stuff. So I do have a resource for you guys to basically go down all the list of potential fraud that you should look out for and be careful of. And even if you're looking for your apartment on Craigslist, there could be a false listing and you gave money as a deposit without, with several other people giving money as a deposit. That was like a big thing in Boston. And, people were giving these people money and there was no unit because they had rented it out to several people. So there's a lot of things to be on the lookout for. So I will provide that information afterwards so that Michelle can distribute to the group. I don't have it in this slide, but I did want to touch on it because I know we had that question initially, and then Michelle will open it up for questions because I think we're running, the 10-minute mark. Long-term savings and retirements, Roth IRA versus IRA. So I would say, when you're thinking about your retirement, your first job really matters, right? And I think the benefits package, it's not just the salary that they're offering you, they're also offering you retirement benefits. And so they will offer you either a 403B, which is a not-for-profit if you decide to work for a not-for-profit, a 401k, which is you're working for a for-profit organization. That is literally tax code. Those are why the numbers sound that way and they have the letters and all that kind of stuff. The reason that matters is because that's going to kind of contribute to your decision making on whether or not you want a Roth IRA or an IRA, the traditional IRA. And it really comes down to tax implications when you retire. So basically with your 401k, you pay for your taxes up front, and then when you pull it out later on, there's no tax implications. With an IRA, you don't have to pay for taxes, but then when you retire, you will pay for taxes. And so the difference there, you want to make sure, do I think I will make more money? And am I in a different tax bracket when I'm older, when I'm quote unquote retiring, than when I'm starting out? And so that's kind of the decision making when you're thinking about your retiring is like, well, I probably will make more money when I'm 65. So the best plan is to diversify. It's not both, because you have it's really tax planning in an investment vehicle. And I think, it gets really complicated because it is complex. It's one of those things where you feel overwhelmed easily because all of these terms are just taxes, making sure that you have enough to live off of when you're just getting, Social Security. It's very overwhelming. So what I would say is start with the benefits of your first job. Gauge what they're giving you. Max out any match that they're giving you. So say, for instance, okay, you have a 401k. You get 2 job offers. Both of them are offering $50,000 to start. One is saying, okay, yeah, we give you a 401k. Well, is there a match? No, there's no match. Oh, okay. So that means only the money you choose to put in will make money in an investment vehicle, and usually equities because you're young. The next job offer saying we have a 6% match. What that means is if I give 6% of my income into my 401k, they will then match that 6%, and you now have 12% of what it is you make in an investment vehicle, making you money for that long-term savings goal of retirement. And so you want to start there before thinking about these other vehicles, because I think what happens is it almost overwhelms you to the point of not starting. Always start. Always save for retirement. I think it's really smart that you're even having these conversations with, your friends and people that are, maybe a year older than you, because I think people are understanding that finance needs to be talked about, because it doesn't have to be something that's, faux pas where you don't feel like you can discuss it with your friends. Have that conversation, but also understand, where am I? And do I need to do this yet? Because I don't have 6 months of savings saved up. And so if I lost my job, I'd have to move out and I'd have to move home. But I really want to have some flexibility. I want to go on some vacation. So do I want to give 6% of my salary to investments, or do I want to 3%? And so there's a lot of balancing that you will do, and it is personal. So it depends on how you want to live your life, what your priorities are, and then make sure you do the kind of research that basically shows, okay, well, either vehicle is going to save me for retirement. Now, what makes the most sense in diversification, so that you have options when you retire, of the tax implications. And that's what that is. Does that make sense?
Yeah, that was really helpful. Thank you.
Okay. Is there any other questions, Michelle, from the group? I know we only have 5 minutes, but I want to, pause there and just.
There are.
Great.
Would you recommend leasing a car or buying a car?
It's a good question. It's very much personal. Think about it like this. Are you going to, this is how I would ask you if I was your banker, right? And when I was thinking about buying my car, I own my car. My car is 9 years old, and I haven't had a car payment for over 5 years. And my insurance is $50 a month. Okay. Because it's an old car. And I think now I'm glad I didn't lease. But I also moved around a lot. It's why I waited very long to buy a car at 28 years old, because I lived in markets. I lived in New York, Washington, D.C., Boston. I didn't need a car. There was trains. And so for me, the mindset of the expense was buying for public transit, not buying a car. What I would say is, if you lease a car, know that that's an ongoing expense that you have to budget for. And there's nothing wrong with leasing, because it will save you sometimes in maintenance, right? So it is about, well, are you going to stay in Boston long? How long do you plan on being here? And sometimes that makes sense for you to just lease your car if you're not sure that you're going to move to New York, where you really don't want a car. And it makes no sense to have a car in 2 years. And so it's a temporary thing, and you don't want to own the car because you don't want to have to sell it later on. It's a personal thing, but you have to do a little bit of kind of where do I want to be, so that you know what's the best option for you, because they're both just options.
Great. And if you close a credit card account, how does that affect your credit score?
Well, what happens is when you open a credit card, it starts your clock of, say, basically saying the length of time. We talked about that slide, and let me just try to pull it back up so I can tell you. Slide 21, Michelle, if you can pull that back up. Mm-hmm. The length of credit history, that's what it impacts. So say you opened it for 3 months and you're like, I'm scared, let me close it. Your length of your credit history is closed. But again, if you have student loans, you're still building credit by paying your student loans back. So it's only one way that it impacts you, and it's a 15% of the overall, pie chart here, because the payment history, which is basically you paying your student loans on time, is 35% of that. That's the big. If you ever miss a payment on your credit card, your student loans, your mortgage, I will know about it, and it's going to be a problem. And so for you, you need to focus on how much you owe and that you pay it on time. And the length of credit history, you can't do anything about it. You're going to, you're going to have, it'll be building as soon as you have credit available to you, which if you have student loans, you have credit available. Credit cards, start off small and then keep one. Just don't open 6 and think you can never close it. That's my point about balance, is you can close it and not have it impact you. It's a very small ding if you close it.
Great. And one more related to the buying versus leasing a car. Is either a better benefit to your credit score?
No, because I'm glad we still have this chart up. That goes to payment history. That's where you're going to go, amounts owed and payment history. So if I look at your, and you're saying, I want to buy a house, and I'm going to say, okay, well, what are your costs? And you're going to tell me, well, I have my student loans. I have my car note. Okay, well, how much is your car note? And you say $700. I'm like, whoa, what kind of car do you have? Now that's talking to amount owed. Number 2 is, oh, I see here you missed 2 payments. Yeah, well, it was really expensive. Well, yeah, you're not going to get a mortgage, right? Or you're going to have to go somewhere, or you're going to pay really high interest. So the leasing versus buying is a completely personal question. That's not about credit score, right? What it's going to impact is if you miss a car note payment, it's the same thing as if you have your cell phone. Don't even think about car. If you have a cell phone payment that you missed and they call the agency and they said that this person is missed, that is a ding. And that's a huge ding on you for the $100 it is, or whatever it costs, that you missed. And so anybody that you owe your cable company, say you owe your cable company and they decide that they want to, basically say you haven't paid a credit owed, your bill, then that's a big ding. And so you want to be cognizant of that. And if you lease versus buy on anything, my personal preference is to one day not pay a lot in my monthly. So the whole reason that I bought a car versus leased a car is because I wanted to get to 0. I didn't want to pay, based on what today, well, you're never going to get below $300 a month for a new car. Well, then I don't need a new car, right? It gets me from point A to point B. This is my thinking. Some people need a new car. Some people don't want to deal with the maintenance. Some people don't want to deal with the fact that after a certain amount of years, you will have more and more maintenance costs. But what I will say is, when I bought a car, I knew that. And so what I did was, even though I wasn't paying them the $300 a month I was paying myself the $300 it was a month, saving it for what I call my replacement car if it came down to my car just doesn't want to turn on one day. And so you're still paying yourself, and now you have more cash to put to your next car. So it comes down to planning, and it comes down to lifestyle and how you want to manage that, if that makes sense.
Great, thank you. And one last question, if you have the time.
Yeah, of course.
In creating a game plan for managing student loans, what are the initial steps you recommend?
So for student loans, I think the biggest thing is it's like your monthly budget. You know, it's a fixed expense. Many student loans run between 10 and 15 years. And so you want to start with your budget, and you want to say, okay, I have my student loans. I think they give you 6 months now after you graduate to start paying back. That little reprieve they give you, be careful, like act like you're paying it, but pay it to yourself. And so what I would say is budget with your salary. That's your income. That's where you start with your budget. And I will give you guys a worksheet so that you can work on this. And unfortunately, virtual, we would have done that in person. But I would say start with whatever it is your offer is and your income is going to be. And then your game plan is your student loans is a must pay. You know that cost is coming. So that's a fixed cost, right? And then you can decide how much can I afford in rent. Okay, now you know how much you can afford on utilities, right? Your rental cost should include utilities, your cable. I mean, there's a lot of expenses that come along with renting. And then it really plays into making sure that every other cost you can control beyond the student loans, because you've already taken out the student loans. And so if you can pay that off faster, you can do that calculation. There's some calculators online, and I can share with you on Bank of America's Better Money Habits website. It's free. You do not have to have an account with Bank of America to use this stuff. And it's really helpful to kind of, you'll be able to gauge for yourself just some of the tools out there for thinking about your student debt and how you want to pay it off and those kind of things.
Thank you so much. We are at time. And so just to respect everybody's time and schedules, we're going to say thank you very much. I will distribute the material that Stephanie gives us to everyone who is here today. And I want to thank everybody for coming. And please be sure to come to our evening events tonight.
Thank you very much, Michelle. Have a great one, everyone. Enjoy.
You're getting lots of thank yous in the chat.
Great. Have a good one.